Greetings, comrades. I've created this practice exercise for my accounting class. This is pitched to Unit 1 and 2 students. It does have a little bit of relevance to Unit 3, 4. So what we're working with here is we have a balance sheet from the previous month with a whole bunch of data, additional information. And from this, we need to construct a budgeted income statement for the following month, August 2025. So I'm going to work through each of these dot points and justify why we are going to include or exclude these in our income statement. Okay, so from the top, we've got the first point for the accounts receivable at the end of the previous period. 2% will be written off as a bad debt. So therefore we need to refer to our balance sheet, go to our current assets. We've got 5K in our accounts receivable and we need to work with this information. 2% of this will be written off as a bad debt. Just a bit of a caveat here, this would be treated a little bit differently when we get to Unit 3, 4 and we work with allowance for doubtful debts. So again, be mindful, this will be managed a little bit differently in the Unit 3, 4 course. Okay, so bad debt satisfies the criteria for an expense because it reduces assets in terms of our account receivable balance and also owner's equity in terms of the impact of our profit. So therefore we're going to report this as an expense, a non-trading expense. So if we work over here on our right in our income statement, I'm going to type in bad debt. Now we can use a calculator, phone, or our brain to work out the amount. I'm going to use Excel. So in my column here, I'm going to use equals from a formula. I'm going to type in the opening balance for AC receivable. I'm going to multiply Shift 8 on my keyboard by 0.02. Careful of your decimals. We don't want 0.2, that'd be 20%. So a bad debt of 100 is our first expense. If we read on, the remainder will be paid off. That's irrelevant to the income statement, but there is a point here, $250 granted for a prompt payment. So just like bad debts, this satisfies the criteria for an expense. It's going to reduce our accounts receivable balance, which is an asset, and simultaneously decrease our OE based on the impact of profit. So that will also be a non-trading expense. So we'll acknowledge that as discount expense because we might have some discount revenue. Okay, which is what we have on the next point. So all accounts payable will be paid off. That's irrelevant to the income statement, but what is relevant is this $200 discount. Now that $200 discount is revenue because it satisfies the criteria. It decreases a liability to our account payable and increases OE in terms of profit. It's not trading revenue, so it doesn't go up the top here. So therefore we need to report it under our other revenue, our non-trading revenue. So we're just going to call that discount revenue to 100. Okay. Next one, credit sales will be, and we're anticipating 12K for the month plus the GST. Ignore the GST, that has no impact on our revenue and expenses. That will be impact the cash flow statement, well not in this case, but the balance sheet in terms of the impact on accounts receivable and our GST clearing balance. We're just concerned with the revenue, which is the 12K. So that's trading revenue. That goes right up the top here. 12,000 in our revenue. Same drill with cash sales. 8,400. That is trading revenue. Ignore the GST. 8,400. Okay. Sales returns anticipated are 400, so we want to keep tabs on that. It's a good KPI to look at in terms of customer satisfaction, so we're going to report that separately in the income statement, and it's going to reduce our net sales. So if we just tab under our cash sales here, we're going to write less sales returns, and we're going to enter this as a negative figure, 400. Okay. Now, there is a cost price impact of this, but it's dealt with by the next point. The markup on all sales is 100%. So when we have 100% markup and we're trying to work out our cost of sales and we know our revenue figure, it's easy. 100% means that our cost of sales will be exactly half of our net sales. So therefore, we're going to need to report our cost of sales. So this point here helps us work that out. And we can simply work that out in our head, or I'm just going to use Excel, equals, I take the net sales figure and I multiply that by 0.5. And then our GP is half of our net sales. And think about it the other way, and in reverse, cost of sales is 10K. If we had 100% markup, 100% of 10K is 10K, and we tack that on to get our selling price, which would give you a net sales of 20K. So that also, that 100% markup, like I said before, it also takes into brings the sales returns into play. So therefore, we've kind of catered for both our revenue and our negative revenue there. Okay, next point, 10K plus GST, that's our credit purchases for the month. That has no impact on the income statement. It will affect our inventory and accounts payable, but they're balance sheet items, and our GST. Next one, depreciation on the premises is 2% per annum, straight line method. This one we need to be a little bit careful on because we're doing an income statement for 1 month, not a year. So what we need to do here, step one, we go to our balance sheets and we look at the historical cost of our premises, 500K, and we work 2% out of that. So I'm going to go over to the right here, and this is non-trading revenue. So we're going to insert this depreciation on the premises, and let's get Excel to work this out for us. So using the formula equals 500,000 times by 0.02, again careful with your decimals. Now that will help us work out depreciation for 1 year per annum. We only need 1 month here. This is a budgeted income statement for 1 month, so therefore we can only allocate 1/12 of a year. So to work out our figure, we're going to divide that calculation by 12, 1/12 of a year. Gives us 833. Same drill with the next one, depreciation on vehicle, 10%. So let's just type in depreciation, vehicle. Again, if we go over to, on the right here, our vehicle is worth, our historical cost is 40K. So same formula as before, equals, open bracket, 40K times by 0.1, it's 10% straight line, will give us a full year's depreciation, and then we divide by 12 to work out the 1 month that we're going to allocate. 333. Okay, next point. Okay, we've got a bunch of cash expenses here. Again, we ignore the GST. So our first one, wages. These are all non-trading expenses. 2,000. I've got some utilities. So that'd be things like electricity, gas, etc. 1,500. Petrol is an expense. Again, ignore the GST. Doesn't affect our expenses. Advertising. Again, I'm just working these figures down the bottom here. 1,600 for advertising. And finally, we've got some interest on the mortgage. Okay, that's an expense. The cost of our mortgage. All right, we're nearly there. Next point, the mortgage is repayable at $1,000 monthly. That's referring to the principal, so that'll reduce our bank and our non-current liability mortgage. Doesn't affect the income statement. A GST settlement will be made. That doesn't affect our income statement. That'll reduce our GST balance and impact our bank balance, but there's no revenue or expense, so ignore that. And then finally, we get to an inventory count, and we've discovered we've had a Christmas present. We've got an inventory gain of $200. So that needs to be reflected in our income statement. So therefore, that goes between our GP and our adjusted GP. So therefore, we're going to plus an inventory gain of 200. All right, so the beauty of Excel is we've worked out our GP, adjusted GP, we've added our other revenue, and we've subtracted all these trading expenses to give us a final net profit of 3283.